This is Signal Stock. Today we are looking at the biggest IPO event in financial history. 3 companies, 3 near trillion-dollar valuations, all going public in the same year. SpaceX in June, OpenAI in September, Anthropic in October. Before we break down each company, let us establish why this moment is different. In 2026, SpaceX, OpenAI, and Anthropic are all filing to go public within a 5-month window. Their combined target valuations exceed $4 trillion. The combined capital they are looking to raise from public markets is over $200 billion. Let us look at the 3 companies side by side before we go deeper. SpaceX is the only one with a confirmed listing, June 12th, at $135 per share. OpenAI and Anthropic have both filed confidential S1s, but have not set a price or date yet. On valuation multiples, the gap is significant. SpaceX is priced at roughly 94 times its trailing revenue. OpenAI at approximately 43 times its current annualized revenue. Anthropic at approximately 21 times. By that measure, Anthropic is the most attractively priced of the 3. SpaceX was founded in 2002 by Elon Musk to reduce the cost of getting to orbit. From near bankruptcy in its early years, it became the dominant launch provider globally, completing 165 Falcon 9 launches in 2025, roughly 80% of all mass launched to orbit. But here is what most coverage is missing. SpaceX is not one company. It is 3 completely different businesses under one ticker, and they could not be more different from each other. Starlink is the cash engine. $11.4 billion in revenue, $4.4 billion in operating profit, 39% margin. The space segment invests heavily in Starship development, profitable on launches but loss-making overall due to R&D, and the AI division, xAI, Grok, and X, merged in February 2026 and immediately became the biggest drag on the balance sheet, $6.35 billion in operating losses in 2025 alone. Before the merger, SpaceX posted net income. The xAI deal turned it loss-making. The slide has the full numbers, including one trend worth watching closely. Starlink's average revenue per subscriber has fallen 33% in 3 years, and the S1 forecasts it will keep falling. Starlink's strengths are real. 9,600 satellites. 164 countries. Near zero marginal cost per new subscriber. No competitor comes close to replicating this at scale. The weaknesses are equally real. xAI is losing $10 billion per year with no proven competitive advantage against OpenAI, Anthropic, or Google. Musk retains near total voting control. Public shareholders cannot change course even if the AI division keeps burning indefinitely. The opportunity investors are paying for is orbital AI infrastructure, data centers in space, leveraging Starlink as the distribution backbone, targeting deployment from 2028. The threats are significant. Starship delays are the #1 risk flagged in the S1 itself. Amazon's Kuiper constellation is growing, and Grok faces a brutal competitive environment. The honest verdict: Starlink is one of the greatest infrastructure businesses ever built. But at $1.75 trillion, you are buying it bundled with a $10 billion a year AI drag, $29 billion in debt, and no governance rights. Morningstar says the fair price is less than half the ask. OpenAI was founded in December 2015 as a non-profit research lab. ChatGPT launched in November 2022 and became the fastest-growing consumer product in history. 100 million users in 2 months. By October 2025, OpenAI completed its restructuring into a public benefit corporation. Microsoft holds approximately 27%. The revenue trajectory is extraordinary, from $3.7 billion annualized in 2024 to $13.1 billion for the full year 2025 to a current run rate of over $33 billion. 900 million weekly active users. Enterprise makes up over 40% of revenue. In Q1 2026, OpenAI reported $5.7 billion, ahead of Anthropic's $4.8 billion in the same quarter. Now the other side of the ledger. OpenAI is projected to burn $27 billion in 2026, rising to $63 billion in 2027. No GAAP profitability, until around 2030. The circularity problem is worth understanding. OpenAI raises capital including from Microsoft, then spends it on Microsoft Azure Compute. A meaningful portion of every funding round effectively flows back to Microsoft, and the 2030 revenue target has already been revised down, from $85 billion to $39 billion. Investors pricing a $1 trillion valuation today are doing so against a forecast that was just cut in half. ChatGPT is synonymous with AI for most people on Earth. 900 million weekly users. The OpenAI API powers hundreds of thousands of production applications with deep switching costs. The Microsoft partnership provides global infrastructure and distribution through Copilot across 400 million commercial office seats. The weaknesses are significant. $27 billion in cash burn this year, rising to $63 billion next year. Microsoft is simultaneously the biggest investor, the primary compute supplier, and a potential competitor building internal models. The 2030 revenue target was just cut in half. The opportunity is enormous. If autonomous AI agents replace meaningful fractions of knowledge work, the total addressable market expands by orders of magnitude. The threat is equally real. Open source models from Meta and others are closing the capability gap fast. The honest verdict: the most important AI brand in the world, with the most dangerous balance sheet. At $1 trillion and 43 times revenue, this is a faith-based price. The faith may prove justified, but it is faith, not margin of safety. Anthropic is the least known of the three. Most retail investors have never heard of it. That may be the most important fact in this entire video. Dario Amodei was Vice President of Research at OpenAI, where he led development of GPT-2 and GPT-3. In December 2020, he and his sister Daniela left, believing OpenAI was moving too fast on capability without adequate safety investment. In January 2021, they co-founded Anthropic as a public benefit corporation. By 2023, Amazon had committed $4 billion. By May 2026, Anthropic closed a $65 billion Series H at a $965 billion valuation. Now pay attention to these numbers. Anthropic's revenue run rate went from $9 billion at end 2025 to $14 billion in February, $19 in March, $30 in April, and $44 to $45 billion in May 2026. It reached a $30 billion run rate faster than Salesforce did, and Salesforce took 20 years. The driver, compute cost per dollar of revenue, fell from 71 cents in Q1 to a projected 56 cents in Q2. That 15-cent shift in one quarter signals the business model is beginning to work at scale. 8 of the Fortune 10 are Claude customers. Claude Code holds 42% of the AI coding market, more than double OpenAI's 21%. And Claude is the only frontier model simultaneously available on AWS, Google Cloud, and Microsoft Azure. Anthropic's core strength is enterprise depth. 80% of revenue is enterprise. 300,000 business customers. 8 of the Fortune 10. Claude Code at 42% of the AI coding market. Multi-cloud distribution across Amazon, Google, and Microsoft that no competitor can currently replicate. The weaknesses are real. The Q2 profit is projected, not audited. 5.1% margin is thin at a near $1 trillion valuation. Revenue is concentrated in a relatively small number of very large accounts. The opportunity is agentic AI for regulated industries, healthcare, legal, financial services, where Anthropic's safety positioning is a genuine commercial advantage. Bristol Myers Squibb is deploying Claude to over 30,000 employees for drug discovery. That is the proof of concept. The threat? Open source models reaching enterprise-grade quality would allow customers to self-host and eliminate API costs entirely. And Anthropic lists last. If SpaceX and OpenAI disappoint between June and September, the October window could narrow considerably. The honest verdict: best near-term financial story, lowest valuation multiple, deepest enterprise moat. 1 binary risk. Q2 audited results confirm or deny the profit projection. Watch that number before the October IPO. Let us put all three side by side on the numbers that actually matter. On 2025 revenue, SpaceX leads, but on current run rate, the picture has flipped. Anthropic now projects the highest annualized revenue of the three, surpassing OpenAI despite being founded 4 years later. On profitability, only Anthropic has projected an operating profit, unaudited, but the trend is real. SpaceX's Starlink makes money, but the consolidated company is loss-making. OpenAI burns the most cash with the longest road to profitability. On valuation multiples, Anthropic is the cheapest of the three by a significant margin. The slide tells the full story. On moat, Starlink's infrastructure is durable. OpenAI has the strongest consumer brand. Anthropic has the deepest enterprise penetration and the only multi-cloud distribution across all three major platforms. On valuation risk, SpaceX and OpenAI are both high. Anthropic is the most reasonably priced with profit emerging. On governance, SpaceX carries the highest risk. OpenAI and Anthropic both have more balanced structures. The slide has the full detail. But one question sits at the heart of all of this. The most famous AI company is burning $27 billion this year. The least famous one just projected a profit. So which company is actually winning? Here is the honest verdict on each one, and the single most important number to watch per company. SpaceX. The verdict: Starlink is excellent. The bundle is not. The buy case is Starlink reaching 100 million subscribers, while xAI finds its commercial footing and Starship lowers orbital costs. The risk case is xAI burning indefinitely with no moat, RPU falling below break-even, and Morningstar's $780 billion fair value proving correct, meaning you paid double. The number to watch? RPU in the first quarterly disclosure post-listing. OpenAI. The verdict? Biggest brand, most dangerous burn rate. The buy case is AI agents replacing meaningful knowledge work by 2028. With Copilot driving 400 million enterprise seats. The risk case is $27 billion in 2026, cash burn rising to $63 billion in 2027, with open source models commoditizing the product before the company reaches profitability. The number to watch? The public S1 filing expected in August 2026, the first time retail investors see the full burn rate. Anthropic. The verdict: best near-term financials, least known. The buy case is Q2 profit confirmed, compute ratio falling toward 40 cents, agentic AI driving enterprise margins higher. The risk case is Q2 profit misses the projection, Anthropic lists last into a fatigued market, and the antitrust exposure from Google and Amazon's dual backer structure creates IPO complications. The number to watch: Q2 audited results in August or September, before the October IPO. Three companies, three near trillion-dollar valuations, all going public in the same year. Who do you think will win this IPO war?